One head scratcher the last couple of weeks has been the seeming disconnect between equities and the VIX. One broad theory is that institutional sellers don't feel like they need a lot of downside protection. What do you think's going on?
Yeah, it's interesting to see this disconnect, especially in the context of, call it 4 to 6 weeks ago when we saw pretty dramatic volatility coming out of the rates market. I would say two things are happening. One is, look, when the markets are down a lot, there's kind of less to hedge. And second, I think a lot of people are on the sidelines. I think a lot of people have de-risked and degrossed. But, I will say one thing. We feel the volatility viscerally, even if it doesn't kind of perform to the same standard that you're seeing from the market. And I do think that persistence in volatility is important because though we saw higher volatility during the pandemic, it hasn't lasted for this long.
Hey, Megan. First of all, well done being in the office on a Friday. I think I see you in the office there. So that's impressive right there. I know you believe that, when we get signs of a panic, that'll be the time to lean into equities. And I'm just curious as to what the signs will be.
Yeah, well, we have seen a decent correction, obviously, in the market at this point. And we've really been grappling with, is this a growth scare? Or is this the prelude to a recession? And at this point, we do think this is just a growth scare. So from that perspective, it would suggest that we're just about there in terms of the historical pullback that you see in those scenarios of 15 to 20%. Now, if it's a recession, it might be 25 to 30%. So even then, we are still getting close to adequately pricing in a recession. But if we're looking at valuations, we're at 16.5 times earnings on the S&P 500, but we haven't really seen earnings estimates come down aggressively. I'd like to see that happen. I'd like to see some of that option hedging pick up a little bit, puts versus calls, and even the VIX. We tend to see those spike when we get that flush out and an indication that we found a bottom. And it just doesn't feel like we are quite there yet. So we're still patient. We still have elevated cash. We're not going to try to exactly and precisely time the bottom of the market. But we tend to see a little bit more stress at those bottoms.
All right. Finally, Amy, we did mention this morning that it's a big expiration day. I wonder your thoughts about how that's driving price action and where big round numbers on the S&P, for example, fit on days like this.
Yeah, it's interesting. Look, options expiration has become more and more important as we see the volumes and options rising. For today, people are really focused on that 4,000 line where I think about 90,000 contracts between puts and calls are going to expire. And then, depending on where we end up during the day, if dealers have short covering to do around collapsing their hedges, then, you could see a moderate rally. But look, what I would say is a lot of these things are really short-lived. They happen in and around the days following expiration, but it doesn't ultimately, destroy the higher themes that are going on in terms of rising rates and, the kind of aggressiveness of the Fed. But those are the things that we are watching in terms of expiration.